Hey everyone, welcome back to another episode of Teaching Thursdays. This week we're going to talk about what's known as share buybacks. It's actually a kind of another trend. I'm not sure if you watched our 7 investment trends through our Periscope program, but there's another trend that's kind of been going on for some time now, and it's a share repurchase program or share buyback program. And a share buyback program simply means that a company is buying back shares from the stock market, and it's seen as they're investing in themselves. But we're going to kind of go through and dissect what that would really mean if you're investing in a company, or if you plan to invest in a company, what a buyback could potentially look like, and how does that affect the metrics of the company that you're researching. So let's say we have company XYZ, and company XYZ has a current stock price or share price of $30 per share. So if you want to buy the stock today, it's going to cost you $30 to buy 1 share of stock. Now let's say their shares outstanding is 2 million shares. So here we have 2 million shares available in the stock market to buy and sell. And then let's say that their earnings is $1. Or I'm sorry, let's say their earnings is $2 million. $1 wouldn't be good now, would it? So the company makes $2 million. And so remember, so if we look at this, we have EPS, which simply means earnings per share. Now we have a video on EPS as well as PE in our BMX TV, so definitely sign up and check that out. The earnings per share, so if a company is making $2 million and there's 2 million shares, that means that their EPS is going to be $1 per share. So the company is in the positive, they're making $1 per share. Let's say the company has a dividend of $3 per share per year. So that means that, and we have a dividend yield. A yield simply means that it's the dividend into the price. How much is that? So $3 divided into $30 is going to be 10%. Let's write that as a percent. And so what's left over here now is the PE ratio, which is just the price to the EPS or price to earnings ratio. So if the stock price is currently $30 and we have an EPS of $1, then 30, the price, divided by 1, the EPS, is going to be 30. PE simply means that it's just a multiple, and a multiple of whatever, the company's earnings is. So if the company is making $1 per share and you multiply that by 30, you get the stock price of $30 per share. So the stock price is 30 times or 30 multiples of what the company is bringing in net income. So that means that investors like you and I are saying, I'm willing to pay $30 for every $1 this company makes per share. So now company XYZ says, we're going to buy back 1 million shares. And you're like, oh, wow, this company's invested in itself. Wow, that's great. That's great. So what happens now is this 2 million shares now becomes 1 million shares because the company said, we're going to buy back 1 million shares. Now, a buyback doesn't happen instantly. A lot of times it's over the course of a year or a few years. But let's just say for this teaching purposes that they buy back and they're gone now. So now the shares outstanding drop down to 1 million. So what happens to the other parameters? Well, if the company is still making $2 million, but there's only 1 million shares, that means that the earnings per share increases from $1 to $2 per share. Oh, wow. So you're like, wow, this company just increased their earnings by 100%. They're doing some big things out here. And so now when we look at the PE, the price of $30 divided by the EPS of $2 now is 15. Now, most value investors will say a normal PE is going to range anywhere from 20 to 25. That seems to be your stable investment. So this company was just slightly above that at 30, but now they're slightly below that. So they're at 15. So now, is the company undervalued? Is there something wrong? Like, what's going on here? Those are things to consider. So what happens is a company will decide, okay, we have this extra cash. We can either do, we can issue a dividend, so start one. We can increase the dividend. We can do share buybacks, or we can do something else with the money. But let's say the option is between a dividend and the share buyback, and they choose the buyback. Well, your dividend is going to say $3, but all these other metrics change, so your EPS went up. So if you're an investor in the company, now you're thinking, wow, I checked before a month ago and they were making $1 a share. Now it's, 2 months later and they're making $2 a share. This company must be doing some major things out here. Oh, and the PE dropped down to 15, so it's getting a little bit more stable. They got more cash coming in and they got less liabilities out here. But that's not always the case because none of the parameters change. That company still makes $2 million. The price is still $30. However, it might look like it's a safer stock and it looks like they're making more money, but that's not necessarily the case. It just, the metrics have changed because the company took away the shares on the stock market. A good example of this is, let's say some Jordans are about to drop and they say we're doing a release of, it's going to be 200 pairs of shoes and each one selling for $1.60. Well, if all of a sudden Jordan says, you know what, next time we're going to do a limited release, and instead of 200 pairs of shoes, we're going to drop 100 pairs of shoes for the same price at $1.60. Well, your earnings is still the same. However, the EPS, or the value of what you're bringing in, has changed because now this company's only dropping 100. So investors like us see, oh wow, it's only 100 pairs out here. Like, we got to get it. That value increases. Now you're like, wow, I got to have it because there's less options for me out there. I can't get the sneakers. And that's in essence kind of like what a buyback is doing. It's limiting the amount out there, so it's adding value. Because when investors now, when you invest in a company and they do a buyback and this EPS increases, now as the investor, you have a higher stake in their earnings. You don't get a direct payout like a dividend would be, but you get a higher stake in their earnings in case they, let's say they cashed out, paid everything out. And that's just how the scenario will work if it was like a pair of J's. Now you're valuing, if it's only 100 pairs, even though I'm paying 160, I would pay 180 for them. But if it's 200 pairs and I'm paying 160, well, I wouldn't pay more than 160 because I got enough options to get them. So now let's say if the company changed their dividend is $3 compared to the 30, so their yield is 10%. But instead of buying back the shares, let's say they increase the dividend, and let's say they increase the dividend to, let's say, $6. So now the dividend increases $6. If the price is $30 and the dividend is $6, 6 goes in there 5 times, so this 10% now becomes 20%. So your two situations here are with your buybacks. Either the earnings per share is going to go up, which is going to cause your PE to go down because it's an inverse relationship. This increased by 2, this decreased by 2. Or increased, should we say, this increased by, 100%. So this is going to drop by 50% because of that inverse relationship. And then the dividend remained the same. But on the flip side, if they increase the dividend, this yield is going to increase. So now the dividend amount that they're paying out is a higher percentage compared to the stock price. So depending upon how you're investing in this company is the main thing you're going to get from here. So if you're looking for growth investing, you're thinking, okay, this company's PE is 30. Now, a lot of technology companies tend to have high PEs, so there's high growth potential. So if you're looking for a high growth potential company, a lot of times you're going to invest in those companies with higher PEs. And then if you're looking for more of the value companies, you're trying to find that PE that's going to be lower because you might feel, oh, this company is undervalued. So if you bought the company when the PE was at 30 and now it drops to 15, you might say, you know what, maybe I should buy more shares because now the company is undervalued. But remember that the earnings still remain the same. That's just something just to keep in mind. And if the EPS change, let's say, they did the buyback and the EPS changed and the dividend didn't change, then that's just something you need to be mindful of, that, oh, the company's still making the same money, but it just looks like it's a little bit undervalued. Or if if now the EPS is at $2, you're thinking, wow, this company is like really making money, but you need to make sure that the company is making money, because if it's a buyback program and the earnings are still the same, the company's not making any more money. So that could give you a false positive, thinking that the company is on the right track to doing things to making more money. So lastly, if you're trying to invest in the company from the income investing standpoint for dividends, if the company is doing buybacks and not increasing or issuing the dividends, you need to be asking, why is this company not issuing or increasing the dividends? Because a lot of investors prefer to have dividends over the share buyback. I don't say everyone, but a lot of them do. And so if they're not increasing the dividend, why not? And if they're doing these buybacks and the dividend's not increasing, what if they do another buyback? So now you need to think, why do they keep doing more buybacks and not increasing the dividend? So not saying that this is a bad company. However, if you're looking to buy this stock for the dividend, you might want to start investing your money somewhere else. You can keep this one, but you might want to start investing your money in something else that does have an increasing dividend. You should look for companies that are increasing their dividend, every year. That's definitely a good strategy for income investing. A lot of companies that increase them every quarter, every 6 months, but at least every year they should be increasing their dividend. That means that they care about their shareholders. So, in a nutshell, that's just how a buyback works. Just remember that there's going to be a stock price for a company, there's going to be a number of outstanding shares for a company, and then there's going to be an earnings amount for a company, how much the company brings in cash. And so if the company is making a certain amount, and if you divide that amount by the shares outstanding, you're going to get how much money this company makes per share. Well, when you find out how much money this company makes per share, you just divide that into what the price is, and that's going to give you the price multiple, or how much you're willing to spend. So now when this price multiple, for instance, dropped to 15, you're saying that as an investor, I'm willing to pay $30 for every $2 this company makes. That means that I'm willing to pay 15 times what this company is making, as opposed to 30 times what this company is making. And then if the company doesn't do the buyback, if they do the dividend, then you need to look, okay, are they increasing their dividend? And how much is the dividend increasing? Is it a steady increase? But that's just in a nutshell, that's how a buyback works. So make sure that you know that a buyback isn't a bad thing. However, you just need to be mindful that the metrics of what the company is going to look like are going to change. Whenever you go to like a Yahoo Finance or any of these sites, you're going to see that EPS on there. You're going to see a PE, or price to earnings, on there. So you need to be mindful that these metrics might change, or should I say, they will change from a buyback. But it doesn't necessarily mean that, oh, this company is sporadically just doing better. It could mean anything. The company just wants to reinvest in themselves and have a higher ownership, in the company and the stock market. So that's just what they want to do. That's their prerogative. But don't think that this company is all of a sudden just booming out here. Be mindful of it. And now with the PE low, it might be a good time to buy even more as well, because now, oh, is this company undervalued? Maybe I should get in. But if the company is undervalued, what's going on with the dividend? So there's different metrics. It just all depends on your approach. If you're value investing, you definitely want to be looking at the PE. Or if you're growth investing, the same. If you're income investing, you want to look at the dividend. And so whenever the buyback happens, just be mindful of that, of what's going on in the news. Peace.